FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and it's 114.19. Well, what is the market going to do? Will Amazon recover from the largest divorce in Western history? That's the question. And can the market handle this mega divorce, or I should say giga divorce? Well, here with us is Eddie Ghabour. But first, as always, please write us, be a part of the show. KL@kerrylutz.com is the email address. Eddie, welcome back.
Thank you for having me.
So what about those? What about those Bezos? Huh?
Yeah.
I was going to say, what about those?
Well,
nuts?
I mean, obviously that's going to get a lot of attention because of the stock itself being, one of the most popular stocks that investors own. And I know the $1 million question is that going to affect the stock price at all? And I think at this point in time, it's too early to tell, obviously. I can't imagine this is going to be something that's settled overnight.
Yeah, that's for sure. Well, the way these celebrity divorces work and divorces among the wealthy is theoretically, of course, the wife is always entitled to half. But in reality, they wind up settling somewhere around 20 to 25% because that's just the way it works.
Yeah. So again, I think it's too premature to try to guesstimate in regards to whether that has an effect on the stock or not. I mean, frankly, the stock has already taken a big hit from its highs. So whether it goes lower or higher in regards to that, I think, again, is just too premature. And I think investors should really focus on the fundamentals of the company itself versus the divorce when they're deciding whether to buy or sell this stock.
So you don't think it matters one way or the other? I mean, it is conceivably a lot of the stock could be flooding the market, though, right?
Oh, sure. I mean, if they have to liquidate their stock for the settlement, then I don't think there's any doubt short-term impact of that would cause a drop in the stock just because of the volume of the shares. But again, I think if someone's solely making their investment decision on that, I think that in the long run, I don't think that's the right approach to take in looking at Amazon from a stock perspective.
I see what you mean. So, but the market in general, what's going on there? I mean, it seems to be fighting its way back. Now it's down a little bit. We in a bear market, and things we see these gyrations, the back and forth, but it's not reaching its old highs. It's still 4,000 some odd points below, or 3,500 points below its all-time high, the Dow Jones. What are we looking at here?
I'm in the camp that I still believe we are in a secular bull market, and what we saw in the fourth quarter was a correction that, frankly, if you look back over many, many, many years, these double-digit corrections happen almost every year and should be expected. Now, there was a lot of damage done to the market in the fourth quarter, especially in December, as stocks really accelerated their sell-off. And then we had the treacherous day on Christmas Eve, and that seems to have formed the bottom here short term. So because of the damage done to the market in that fourth quarter, I don't think investors should expect markets to hit all-time highs anytime soon. It's going to take time for it to get back. But let's look back from an investment standpoint as far as what the two things that were causing this volatility was the concern that the Fed was going to raise rates so aggressively that they would invert the yield curve and cause us to go into a recession, and trade deal with China. Well, right now, short term, the Fed is off the table. They're not going to raise rates this next meeting. They've given every indication they're going to pause. And if we get a China trade deal anytime in the upcoming months, I think that really supports our bullish case. Couple that with the fact that I don't see a recession happening in 2019 like so many people are predicting.
Well, there's good and there's bad. On the one hand, you see the employment numbers really strong last month. On the other hand, that employment numbers are a lagging indicator, and generally they're best right before the peak.
Without a question. And I'm not saying that you're not going to see a slowdown. I mean, let's face it, the growth that we saw last year from a economic and earnings perspective is an unrealistic growth rate to consider it consistently. But to go from where we are now to having 2 consecutive quarters of negative GDP in 2019, I just don't think that is a realistic expectation to go from where we were just a month ago to expect things to decelerate that much that we're going to go into a recession in 19. I don't see the catalyst unless the trade talks with China implode and all of a sudden there's a 40% tariff on everything that goes in and out of both the U.S. and China. But that doesn't help anybody either. So I don't see 2019 being a recession in the cards, but I guess time will tell on whether I'm right or not.
Yeah, well, time will tell. Nobody knows for sure. At some point, though, we are going to have another recession, aren't we, Eddie?
Oh, without question. I mean, we know things don't just go straight up. And you know what? Everyone can make their predictions as what they think is going to cause the recession. But most of the time, it's something that just blindsides us that's not even on the radar right now. Because everyone is kind of saying the same thing. The fundamentals look good. Balance sheets are good. But inevitably, we will go into a recession at some point in time. And when it does, the hope is that it's a soft landing and not a hard landing like we saw in 2008 and March of 2009.
Yeah. So maybe it'll be a soft landing. I don't know. But there's been a lot of money printing, a lot of debt run up, a lot of problems that are kind of masked over right now. We got state and local pension funds, states like Illinois on the, balls of their behind. And, it makes you wonder, like, how solid is this recovery?
Yeah, I don't think that there's any question that anyone should be concerned about debt. I mean, that's financial planning one-on-one, whether you're talking to a family, a company, a country, or a state. If you over-leverage yourself, there is going to be a day that you have to pay the piper. And I think that's a concern from a market standpoint is, yes, why so much fear was on the Fed is because people realize that there's a lot of corporate debt out there. And if rates go too high and the cost of capital increase, some of these companies are going to have a hard time paying their debt off. And so, yes, I think debt is something that investors should keep a very close eye on, which is why when you're in the later stages of a recovery, I think you got to be even pickier with the types of companies you invest in. And that would be something I would look at is, how much debt are they over leveraged or not? Because at the end of the day, anyone that has too much debt, when the economic cycle turns and it goes negative, those are the ones that are going to get hurt the hardest.
Yeah, that's for sure. We know that. We've seen it many times. That's the way the economic cycle works. Excessive exuberance, over leveraging, overspending. So where do we go where they're not going to get burned, Eddie?
I think you're going to have to, for investors, I know our client base is a pretty conservative client base. I mean, they're looking for companies that have a consistent dividend stream, that has good cash flow, and has a history of increasing their dividend. Because at the end of the day, yes, those stocks traditionally aren't as volatile as the technology stocks and the high-flying stocks, so they don't have the same upside potential that they do, but the hope is that they don't have the downside either. And, of course, everybody's investment situation needs to be looked at on a one-on-one basis and with risk tolerance and income needs and everything else, but I think that's where investors should really start to take a look at is dividend-paying stocks that have a good balance sheet and a history of increasing their dividend yield.
Yeah, and obviously, those are the stocks that have kind of proved themselves over time, almost like those Buffett stocks, right?
FSN Radio. It's all about what's next.
Egypt is on the verge, once again, becoming a world-renowned gold producer. The golden age is being rediscovered. For millennia, ancient Egyptian kingdoms prospered from unparalleled riches. Pharaohs built their empires and flaunted their abundant wealth that was made possible by the country's resource-rich gold deposits. Despite this rich history, modern Egypt remains one of the most underdeveloped gold mining countries in the world. Aton Resources is at the center of the modern Egyptian mining world, diligently working both as the only public exploration company in Egypt today and as the advocate for mining reform with the Egyptian government. However, those that arrive early like Eitan will reap the best rewards. Eitan's discovery of the legendary Lost Mountain of Gold at Rodruin and its current aggressive drilling program there could potentially reap those rewards. Eitan Resources is focused on its 100% owned Abu Marawat concession in the Arabian-Nubian Shield, located 200 kilometers north of Centamin Sakari's world-class gold mine. Eitan possesses first-mover advantage in the under-followed jurisdiction of Egypt, which is currently undergoing mining reform. To stay on top of Eitan's latest drill results and news, go to eitanresources.com. Eitan trades on the TSX-V under the ticker AAN and on the OTC under the ticker ANLBF.
The Financial Survival Network. It's all about what's next.
Yes, I mean, Buffett's been known as a value investor his entire life, and that's where he's built his reputation and, of course, has done a fantastic job of it. But let's face it, if we do go into a recession and there's a broad-based sell-off, those stocks will lose value as well, too. The hope is that they hold up better and are able to meet their dividend obligations for investors.
Yeah, so it's different kind of investors are in those dividend stocks than in the so-called growth stocks, your Amazons, your Apples, et cetera. Hey, I was looking at Ford. So Ford's in trouble now. Stock's below $10. Their dividend is 6.75% just about. Does that make them a buy or does that make them a sell?
Well, frankly, when I see a dividend yield that seems too high, like when I hear whatever the name of the company is, and I see that the 10-year Treasury note's under 3%, and there's a company paying, over 6% dividend yield, I'd look at that as a red flag that something's not right. And it's like the old saying, if it sounds too good to be true, maybe it is. That tells me that the dividend yield, is it sustainable, And I'm not an analyst on Ford stock to be able to say, look, they're not going to be able to pay this dividend. But it's the same thing if you look at what happened with GE. Their dividend yield got really high. Some investors got too excited too early, and then they had to cut the dividend because they just couldn't carry that cost. So I think that's a concern when you look at a company like Ford or any company out there that's paying a really high dividend. If it's double what the 10-year is paying, I think that's a red flag that there's some risk out there. It's the same way on the debt market. There's a company out there that has a bond that has a huge yield. There's a reason why they're paying a huge yield, because it's risk reward. Mm-hmm.
So do you think that value investing is going to make a resurgence now, Eddie?
I do. Now, full disclosure, I thought value was going to do really well last year, and it didn't because growth continued to be the play. But, everything always reverts back to the mean, just like, as you said earlier, eventually we're going to go into a recession. So growth has outperformed value, such a big delta between the two, that I think that's going to start to shrink. And short term, really short term, you're starting to see that with the banks. The banks are value companies, and they have not participated in the gains in the market like the growth stocks have. And in December and the fourth quarter and heading into this year, they've actually held up quite well relative to other sectors. So maybe that's the beginning of value becoming a more popular place to be for 2019.
That would be interesting, wouldn't it? Because it's been years and years. It's really since the Great Recession that value has kind of been in the dumps.
It has, but again, I think when you're looking at the later cycle of the economic recovery, investors are definitely more nervous now than what they were, especially after the beating they took in the fourth quarter. And I think that they're conscious of that. So as they enter back into the market, I think they will probably take a little bit more cautious approach because they don't want to get whipsawed and take huge losses on these high-flying companies.
Yeah. So when you look at sectors of the market, and you're talking value, what sectors do you see particularly value-driven now?
So I do like the banks. I like the big banks. They have a decent dividend. From a relative perspective, their PEs are pretty low, and I think they can cover their dividend. It's nothing extraordinary. And then I still like energy. I mean, I'm a contrarian by nature. Energy, obviously, we know took an absolute beating in the fourth quarter last year, but there's some large energy companies that pay a nice dividend that I think are able to cover those dividends when we have a downturn, and it'll be a consistent income stream for investors.
Interesting. Well, but banks, they don't have very transparent accounting. You don't really know what's in all those footnotes. If you can understand them, my hat's off to you. Do you think they could be setting up for a 2008, 2009 repeat?
Obviously, everything's possible. I don't think so. Again, I think when you look at all the bubbles that burst and when they burst, very rarely will you see it's the same one that happened the prior time that happened. So last time it was the banks. They were over-leveraged. They weren't well capitalized, and that's what started the spiraling down. I don't think that's going to be the case the next time we have a recession. I would be more worried about corporate debt than I would the banks as what's caused it last time.
Yeah, well, some of these banks have loaned out money to hedge funds. There was just an article about Citicorp writing off $180 million loaned to an Asian hedge fund. So they've always got all of these, they've always got all these questionable loans, no matter how you cut it. You think this time really is different, huh?
Well, from a bank standpoint, I do. And again, but one could also argue, I mean, they've lost a third of their value off their 52-week high. So isn't some of that already priced into the stock itself? Mm-hmm. So it's not like we're entering into banks as they're at all-time highs. I mean, these stocks have really taken a huge, and what I think is a huge drop from their high just a year ago. I think Citigroup, to your point, I think it was trading at over $80 a share. Mm-hmm. About a year ago, and it's in the let me look, it's $59 right now as we speak, and that's with a 4% bump that it's seeing today. So they really have not performed well at all. Yeah,
definitely not. And a lot of the stocks that we look at here, Eddie, when you get away from the averages from the Dow and the S&P, have really taken huge hits. Right? I mean,
they have. I mean, you're talking 20+% drops, and most of that happening in the fourth quarter. And again, which I think is healthy for a market. I think these types of corrections are good. It keeps people on their toes, but more importantly, it causes people to go to the sidelines. I mean, I think that I read an article this morning that we're back to record numbers of investors are going into cash right now because of fear. You don't see that when you're getting ready to burst a bubble in the market. Usually there's a euphoric stage before you see that happen. And so that fear in the market, as silly as this may sound, is actually a good thing, for a good case to continue to keep this market moving upward for 2019.
Yeah, it's kind of dampening the rampant speculation, huh?
Correct.
So, and that's what you need. It's just a question of whether the market's going to return and go to higher highs, or if this is in fact a bear market. And as it drags along, more and more of you out there are believing that it's a bear market. I'm not convinced yet, but I'm starting to lean towards it. But it's one of those kind of things. Will Trump be able to pull another rabbit out of the hat?
Yeah, at the end of the day, I think you're going to keep a close eye as an investor on interest rates. Interest rates are going to I think that will be what ends up causing the market to go into bear market territories if the 10-year gets too high. So I think as long as the 10-year is where it is now and the Fed stays tame, it's kind of like the best house in a bad development.
Yes, I know exactly what you mean. And Eddie, you want to find out more about you, read your work that shows up on the web quite often. Where do we find you these days?
So you can find me on our website, which is keyadvisorsgroupllc.com, or you can follow me on Twitter at Common Sense Bull.
All right, at Common Sense Bull. And hey, if you got any interest, write us an email. We'll read it on air if it's really good. And if it's really, really good, we'll interview you. And hey, please, whether you're watching on YouTube or listening on the usual podcast channels, please subscribe, like, and share us. It really helps me a lot when you do that. Helps the show, helps get it out to more people. And if you got a friend who think would enjoy the show, then please send them out a link. Eddie, it's always a pleasure having you on. We'll talk to you again real soon.
Thank you so much for having me.
FSN Radio. It's all about what's next. Go to FinancialSurvivalNetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.